Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
You've probably heard this term a time or two and wondered, what are they talking about? Tax loss harvesting. That is what we're talking about today, specifically what it is and also a step-by-step guide. Welcome to the College Investor Audio Show. Let's get right to it. As an investor, tax loss harvesting can help you lower your tax burden. Although no one can completely avoid taxes, darn it, harnessing the power of tax loss harvesting can help you legally avoid paying more in taxes. That's wonderful. So why not take advantage of this strategy? First of all, it's important to understand what the heck tax loss harvesting is. Essentially, tax loss harvesting is a tax strategy to lower your overall tax liabilities. In this strategy, you sell investments that have lost value and replace it with a similar investment. After this transaction, the investment sold at a loss will offset realized gains. With that, you are able to offset your income for the year. Boom! When an investment has lost value, tax loss harvesting is a good way to benefit from the downturn. Even if you don't have any investment gains for the year, you can use this realized tax loss to offset your ordinary taxable income. Tax loss harvesting can be a useful strategy for investors that want to minimize their tax liabilities. So let's take a closer look at the ins and outs of this kind of plan. Okay, so here's how to harvest tax losses if you're interested in doing this. The good news is that it is a relatively simple transaction. Step 1, monitor your investment for value loss. Just take the time to monitor your portfolio for investments that are losing value. When you notice a substantial drop in your investment's value, then it may take time to consider implementing a tax loss harvesting strategy. Step number 2, sell the investment at a loss. When you find an investment that has lost value, sell it. At that point, you will realize a capital loss. Without the action of selling the investment, the loss remains unrealized. And then you miss the chance to harvest. For example, let's say you invest $10,000 into a mutual fund. 6 months later, the investment's value has dropped to $8,000. No! However, at this point, you have the opportunity to pursue tax loss harvesting. If you miss the chance to sell your investment and it rebounds to $11,000, then you won't be able to use the temporary loss in value to minimize your tax liabilities. But it increased in value, so that's good too. Step 3, repurchase a similar investment. So once you sell that original loss, it's time to reinvest those funds. When you select a new investment, you'll need to make sure that you're purchasing something very similar, but not identical. The IRS will not allow you to pursue tax loss harvesting if you purchase identical investments, otherwise known as a wash sale. A similar investment cannot be substantially identical to the original investment. However, it is possible to purchase different ETFs that target similar industries. Although you won't be able to purchase an identical investment, a similar one is going to allow you to stick to your investment goals and then also take advantage of tax loss harvesting. Here's step 4. Claim the loss. Once you've completed the mechanics of a tax loss harvesting transaction, the next step is to claim the loss on your tax return. This would be the final step, and it'll allow you to realize the tax loss in a meaningful way. And depending on your tax bracket, by the way, you could save thousands with the help of this tax minimization strategy. Very cool. Limitations of tax loss harvesting. Of course, there are some limitations to this. It's an exciting way to potentially save thousands, but let's take a look at the limitations that the IRS puts on this strategy just to prevent abuse. Of course, we talked about this, but the wash sale, this prevents investors from attempting to harvest tax losses with identical investments. Under this rule, you can't claim a capital loss on the sale of a security against a capital gain of the exact same security. Makes sense. With that, you can't buy and sell identical securities within 30 days before or after the sale to claim a capital loss. If you move forward with the buying and selling of identical securities within 30 days, the IRS will not allow you to claim a tax write-off. Most importantly, you can replace investments with similar mutual funds of ETFs. With similar mutual funds, your investment portfolio can be relatively similar without violating the wash sale rule. Also keep in mind, this is for taxable accounts only. Of course, tax loss harvesting is only allowed in taxable investment accounts. It makes sense. Other investment accounts that are tax deferred, like an IRA or even a 401k, cannot benefit from tax loss harvesting because they're not subject to capital gains taxes anyway. Limit to offsetting opportunities. Although this is a viable strategy, there is a limit to the amount of realized capital losses that you can claim. As a married couple filing jointly or a single filer, you can realize up to $3,000 of capital losses to reduce your taxable income in a given year. If you're a married couple filing separately, then you will only be allowed to claim up to $1,500 of capital losses in a given year. So with these limits, it can still be worthwhile to pursue this tax loss harvesting. However, it's important to keep the limitations in mind. Let's talk about some additional costs too. When you're attempting to complete one of these transactions, each time the market loses value, the transaction can become a little bit burdensome to record. You might incur some costs or administrative costs when it is time to prepare your taxes. Now, before implementing tax loss harvesting in your own portfolio, do this. Weigh the costs of completing the transaction and filing your taxes. You don't want to go through the effort of doing all this stuff if the costs are going to be too high anyway. Here are some final thoughts. As you consider this strategy, don't prioritize this over the value of a well-balanced portfolio. Although, you can save on your tax bill through this strategy, it should not take precedence over building a portfolio that aligns with your investment goals. If you're starting out on your investment journey, take advantage of all the stuff we have. Free resources, all kinds of stuff to help you build a portfolio that works for you. It's at thecollegeinvestor.com. Thanks again for stopping by today and listening. We're so thankful for you. Have an awesome day, and we'll talk to you again real soon.